One point, I think you said you thought Bitcoin was going to go to 200,000. Maybe you said even higher than that. Do you still think that, or have you tempered your own expectations as a result of where the landscape currently sits?
It's very hard for me sitting here to give you a price prediction, but I can pretty confidently say that Bitcoin, I think, has effectively replaced gold, and it will continue to do so. And so that market cap is just going to grow. And then for the first time, I think we're seeing the initial versions of the solution that we thought Bitcoin was supposed to be. Smart contracts and, better savings accounts, better insurance, better credit scoring. And that's happening through this DeFi stuff that's being built on Ethereum and Solana. These are the terms that, people are. I'm very concerned about medium-term inflation. And so in an inflationary environment, in my very simplistic view of the world, I want to own three things. Hypergrowth, because hypergrowth can always outrun inflation. Think of that as like companies that are growing 50+% a year. It's incredible growth, right? Then I want to own cash generative assets. Think of that as like, a great example is like a mining stock. I know that sounds crazy, but it's pretty incredible. And then I want to own non-correlated assets. Bitcoin, Solana, DeSo, a lot of the DeFi protocols, because it's a great counterintuitive hedge against all of this stuff. Now, most of the dollars are here, small amount of the dollars are here, but that's how I see the world, because I do worry that we've pumped an enormous amount of money in the ecosystem, and it has to show itself. And when we start to balkanize these supply chains and regionalize because of China, prices are going to go up.
And how much are stocks going to go down? I mean, it sounds like you're worried about the stock market for all the reasons that you said.
I don't think the setup for me is all that bad, because I tend to prefer hypergrowth. Again, because I think hypergrowth is the only kind of stock.
Like, what's an example of that? Is there a name
well, I mean, if you look at
specifically?
if you look at the ones that we own, I think if you look at the projections of SoFi, you look at the projections of Open Door, you look at the projections of Clover, how they performed even in the last quarter. We own businesses that we think can grow a lot. But outside of that, I really like offline businesses that are highly cash flow generative right now, because I think it'll be a very protective asset. Broadly speaking in the market, I'm a little skittish, yeah. The place you have to look to start is in China. I think that a lot of investors, institutional investors, have a business model that really needs China to be an investable place, right? Hundreds of billions of dollars of foreign capital, you can charge fees, you can generate profits. But I think what you see is that game is over. And so we're seeing the beginnings of the vertical integration of China, China Inc., right? One country, one economy, one CEO, Xi Jinping. And that has huge ramifications to national security. It has huge ramifications to supply chains, to inflation. And I think as people really come to terms with this and come to grips with that, there's going to be a lot of opportunities to make money.
Are you suggesting, though, that right now China is uninvestable for U.S. investors?
I have always said that I can only invest in a place if I really understand how the money goes in, the rule of law, and then most importantly, how the money can come out. And what I've seen over the last 6 months has really shaken my confidence in my ability to predict what happens next. And so from my perspective, it's a place that I right now will read about and not invest in.
Do you expect more volatility, though, in the U.S. markets?
Enormous, yeah. Look, I think, shook off inflation. There was like a little bit of a head fake leading into May. If you looked at sort of where 10-year break-evens were, there was like a little sprinkling, and then break-evens were there was like a little sprinkling, and then by and large it went away. But now what we see again, if you fold China back into the equation, if you fold this, supply chain issues that we have, the regionalization we need to create over the next few years, prices are going up.
So I want to talk about one area of the market that is really your specialty, and one that has clearly re-rated, and that is the SPAC market. CNBC's post-SPAC index is down 32% this year. 2/3 of SPACs that went public this year are trading below their offer price. Was it all a bubble?
No, but I do think that in the beginning of every market, you have a few people that pioneer something, and then you have a lot of fast followers. And I think it's always important to take a step back when you have all that fast following to sort it out. And I think we're in the midst of sorting that out and separating the wheat from the chaff. Who are the quality sponsors? Who underwrites good deals? And most importantly, and I've said this to you before, who has skin in the game? And when you look at that, and if you take your index and separate it by the people that actually invest their own money, I suspect there's a tale of two stories there.
You've said that SPACs need to be better regulated or scrutinized. Against what?
Well, my perspective is that right now the incentives aren't aligned to create great outcomes from the beginning of a SPAC to the end of a SPAC. And the most important thing we need to do is to force the people that are the sponsors to have much more capital at risk. So for example, I think Gary Gensler would be well off by saying for every dollar of SPAC money you want to raise, 5 or 10 cents needs to be your own. And so if I want to raise $1 billion SPAC, I have to come up with $100 million. I suspect, Scott, I may or may not come up with a good deal, but I'll take that really seriously and pay attention. And that has a bunch of very positive knock-on effects. Here's the great thing about SPACs. You have an opportunity to have months to get behind people who you think may find a good deal. And then you typically have months to completely underwrite the business, see how the entire rest of the market reacts to the business, and stay in or get all of your money back. That to me seems like an incredibly investor-friendly thing to do. I can't do that in an IPO. I can't do that if I buy some bonds, but I can do that in a SPAC. So net, I think it's a useful and important part of the capital markets. People just need to take their time, do their own work. I go back to the same things, and make sure you look at the incentive, ask yourself how much of their own money is on the line. I think if you do those things, it will clarify a lot of what's happening in the SPAC market.
Brad Gerstner made the point that, as you say, skin in the game is important, but also staying power, making you stay.
I think lockups are artificial. I've been on all sides of this. I've been a CEO subject to a lockup. I've been an investor subject to a lockup. And I've been an employee of a company that went public subject to a lockup. The one thing that I always found odd with lockups is that they always hurt the people that spent the most time, and they all benefited the people that had nothing to do with the business. Some random hedge fund shows up at the 11th hour, gets an allocation in a book, and completely can trade in and out of this thing. So to me, it has a negative connotation because of how historically it's been practiced by Wall Street. If it were fixed in a way that was more democratic to everybody, I'd be supportive of it. In the meantime, the way that the rules are right now, folks that come in literally yesterday have no restrictions, and folks like me who are involved for years have enormous restrictions. It should probably be the opposite. That would be the best way to fix lockups. In the meantime, go back to skin in the game.